We've got Satya Bansal, who's Chief Executive Officer of Barclays Wealth in India, who joins us right here in the studio. Satya, to begin with, you know, this whole thing of the shift to treasure assets by high net worth individuals. We've got numbers for countries across the world. We've got something like 19%, I think, for the US. Double digits pretty much in every market across the world. India's got only 3%. Why?
I personally feel that it's a lot more to do with the wealth creation cycle at the moment. India, I mean, as per the report of Profit or Pleasure, which we just released, the numbers what we got is just only 3% for Indian high net worth and ultra high net worth clients. It's largely to do with two things. One, mainly because of wealth creation cycle. I believe that right now we are still in the wealth creation mode, so possibly investing in treasure asset is something which is still being explored by most families. And second, very important aspect was report brought in, and it throws a very important light on a critical subject, is whether to invest in treasure asset or to invest in something which they feel that it's more productive asset to be invested with. And 72% of respondents in the report identified that they would like to invest in productive asset, and they feel that investing in treasure at the moment may not be the best option given the wealth creation cycle that we are in. So possibly it has a lot to do with wealth creation cycle and the belief that you need to invest in treasure versus other productive investment or business assets at the moment, given the kind of level of scale of development that we are right now in.
Satya, afternoon. Would you say that the impact of the 2008 financial crisis on traditional asset classes like fixed income, equities, real estate has led high net worth individuals across the world to move on to treasure assets?
To an extent, yes, but I would say most of the treasure assets are driven still by more of a passion than a logic of financial investment. And as the report clearly highlights, that it's more of emotions which play a larger role to decide whether to invest in these treasure assets or not. So I personally believe that the financial logic of investing in it is only a very sub part of it. So I believe that's yet to be fully deciphered. But if you look at the overall situation, I mean, if you look at the report, and it clearly highlights that as a global village, we have invested more in the last 5 years in treasure asset than what it was. So we have obviously much higher level of investment in treasure asset at the moment as compared to what was the 5 years back. But at the same time, I believe that the investment which could have happened in treasure asset is not as much as had the 2008 financial crisis not happened. So that's how I would like to read it at the moment.
Right, so Satya, you know, we did say talk about Indians being the lowest in terms of their wealth going into treasure assets. But even in the shift to treasure assets by Indian HNIs, which are the top 3 categories into which money is flowing within treasure assets?
So I'm picking up the data point which has come out of the survey of 2,000 families across the globe, including a large number of families from India, more than 100. So the top 3 assets for the Indian high net worth and ultra high net worth families in treasure category are precious jewelry, vintage cars, and third, very important, is antique furniture. In that relative order, that's how they have invested in. So I think precious jewelry still accounts for a larger part of our treasure asset for most families. And to a large extent, it has to do with the culture with which we come from, and more importantly, the emotions associated with some of these treasure assets in the family.
Sure, and Satya, deviating from the report, and if we were to talk about the general momentum that we've seen in the markets, you have seen quite a bit of instability which has creeped in on the back of all of the global as well as domestic news. Which are the sectors in light of this that you would be bullish on and that you believe an investor should stick their neck out and put their money in?
Okay, I think let me just relate it to when we are in the current environment, when there's a lot of gloom and doom being talked about. It's very important to relate it as to what has happened post 2008, and I think that would to an extent reflect upon how the investors would respond in the current environment, because there's a significant learning most of the investors have. First and foremost learning, I think, in 2008 crisis most investors had, and I think the portfolio was more important than the individual component of the portfolio. So, and that was something which I believe pre-2008, at least in markets like India, was not being that respected. So when it comes to portfolio investments, I think the focus on individual component, which stock has performed better, which sector has performed better, whether my equities have done well or debt has done well, I think to a large extent investors have now realized that it's a portfolio which matters more than the performance of the individual asset class. So what is happening post 2008 is that investors are looking for more normalized return on an overall basis than looking for those exceptional gains in one specific asset class, but at the same time losing out on rest of it. So I think it is more to do that it's a portfolio approach which is important. Second thing, if I can really look at it, I think there is a greater focus on risk and reward now. So, I mean, let's look at the current environment. When there is so much of debate, just now we were talking about what happening in the Spain or what's going to happen to the Greece election. Now, there are obviously risk and reward associated with taking a call on that. So, what has happened? The investors are now taking far more cautious calls. So, if you feel that euro is not going to be in the situation which most people are fearing of, then maybe it's a time for people to get into some risk asset class when the valuations are one of its lowest. Now, having taken that call, which sectors to get in is again a debatable subject. And that again I'm saying you because you cannot generalize it. Just to give an example, infrastructure as a sector. It's a beaten down sector at the moment if you look at it from pricing point of view. Most of the companies are available at throwaway price. Given the numbers these are producing, be it the asset number or be it the overall potential numbers. But most investors may not be considering infrastructure because the history does not reflect anything bright for them to really consider. But for the investors who are looking at an overall portfolio level and risk reward metrics, some of the beaten down sector obviously could be far more cyclic and give far higher uptrend in the portfolio than going by the herd mentality of sector which have performed well. If you look at overall from an overall perspective from sectors, there are still sectors which are still evergreen, like pharma, like some of the companies people have been started looking at in the FMCG space because of the consumption story and the generics play that we have. But apart from there are I would say counter-cyclic themes which are emerging right now for the investors who are willing to look at those kind of risk-reward pattern, provided they are overall following some kind of a better portfolio approach post-2008.
Right, but Satya, would you say that among HNIs in India, there's still money that equities continues to be the most favored asset class, or would you say that because of what we are seeing play out in equities, there's a lot of money moving to other asset classes like maybe real estate, fixed income, precious metals?
Yeah, I think all asset classes are important, and I feel there is a general diversification of assets in most of the client portfolios. Now, coming back to real estate and other things, these are, again, there's a lot of things associated with inflation versus physical asset, whether you should get in or not. And these are more, I would say, individualistic preferences than a portfolio construction per se. But if you look at the financial assets between debt and equity, I think this seesaw is going to be always there. And I personally believe that in the long term, equity has to perform to pay off the debt. If we are predicting a very fearful scenario for equity, then the debt carries a far more risk than possibly equities. I mean, if you look at it on an overall portfolio basis. But what typically happens that will the investor consider investing in equity at the current level? It all depends to what extent they are willing to take bets on their view on what's happening in Eurozone, what's happening in the global environment, what's their view on with the policies of the government at the moment, what is their view? And I think for those investors who are willing to take some amount of risk, given that they have already created some amount of defensive portfolio, equities could be a good bet in the year 2012 to accumulate their desired stocks or the stocks which are beaten down otherwise.